Hello and welcome to the SIA Wealth Management Advisor Update for April of 2025. My name is Colin Cieszynski, Portfolio Manager and Chief Market Strategist. This month in our presentation, we're going to look at recent changes to the economy and investor sentiment and do an update on global markets. It's been an incredibly volatile month. I mean, with everything going on with trade and tariffs and market volatility and so we'll look at how we've been navigating through this, both in terms of an overall look at the markets, but also how our portfolios have been navigating through this increased volatility. To start off with our overview of the economy and markets, markets clearly have been moving fast and furious, and we can see that we've had multiple changes, not only between days, but even massive days intraday, massive swings intraday as well. Big reversals, big swings in trend. We had the 2-day 10% plus loss in the S&P 500. That was the fifth time that happened in 40 years, and the first time since March of 2020. On the rebound, the following week, the Nasdaq posted a one-day gain of 12.1%. But at the same time, it's interesting. We're seeing a lot of volatility in U.S. bonds and Treasury yields. We're also seeing the U.S. dollar is in retreat. Crude oil has been bouncing around $60. And the most interesting thing is that through all of this, precious metals have regained their footing. Gold has rallied to new all-time highs, and it's an indication that there's still a lot of fear out there and that investors remain defensive amid the ongoing uncertainty. We can see our increased volatility. We look to the VIX index and we look for VIX spikes. And we can certainly see that we've had one this month. We had a big breakout in the VIX over 28, and it ran up above 4, pretty much to 50 on the VIX. It has come back off a little bit. It's come back closer to 30 now, but still we can see that it is up higher. We're into a higher range of increased volatility, and we're kind of at or above the top of the range that has kind of prevailed for the last 5 years since 2020. The VIX had kind of been in a 10 to 30 kind of range, and now we're kind of up at the top of that. So we are in a situation of elevated volatility, elevated risk. The trade war has had a significant impact on the economy. We've seen the market started to sell off really hard when Trump actually delivered on his promises and brought in reciprocal tariffs. Then we had that huge rebound when he decided to delay them for countries that agreed to negotiate with him and didn't fight back. But there's still the 10% blanket tariff. He's still fighting it out with China. And today, as we're recording this, the technology stocks are getting hammered because they're starting to see the impact of all of this on the semiconductor sector. So it's ongoing, and it seems like one day or another, it's almost like whack-a-mole, where every time we think that okay, everything's settling down, something else pops up, and it just keeps going like that. So in this kind of a whack-a-mole, uncertain, volatile market is what we're in, and this could prevail for some time yet. Meanwhile, we are seeing signs of a mixed or slowing economy. Now, there's been increased chatter about a potential U.S. recession. Copper has been falling. Crude oil has been under pressure. U.S. inflation has been easing, though. That's good news for the potential of future rate cuts. China's inflation has actually gone negative into deflation. And we've had mixed economic data. This morning, we had very strong U.S. retail sales, but a couple of months ago, the U.S. posted the highest layoffs since 2020 with their cuts to government spending. So there's a lot of different things happening at any given point in time. Looking at how the U.S. has performed over the last 6 months relative to the rest of the world, we can see a crossover about the beginning of March, where up until then, October through the fall after the election, U.S. was outperforming Canada and international. It started to tail off in February, and then going on through March and into April, the U.S. is now underperforming relative to other markets. And even in the sell-off, Canada and international went down less, and on the rebound, they're up more, particularly international. So we've definitely seen a rotation of capital and capital flow from the United States to international markets. That's something important for us to remember as we move forward. In terms of the relative performance of currencies, I look at the black line, which is the U.S. dollar index, and it's similar to U.S. stocks. It was doing pretty well up until January, pretty much peaked right about the inauguration, and since then the U.S. dollar has been trending downward. Gold As the U.S. dollar rolled down, gold took off again, and is the orange line gone to new all-time highs. But we're even seeing that the Canadian dollar, under all the threat of tariffs over the last number of months, it went down towards the end of the last year. It stabilized through the winter, and the Canadian dollar has started to pick up in recent weeks, as has the euro. Something really important and a pretty major signal we saw earlier this week is a death cross in the S&P 500 index. Now, the golden cross and the death cross are when the 50-day moving average goes above or below the 200-day moving average, and they've historically been seen as indicators of a significant trend change in the overall market, particularly when it happens in the S&P 500. So this is a 5-year chart of the S&P 500, and what we can see is we had the death cross in March of 2020, the golden cross in a little later in 2020. Then the markets went into an uptrend, and then in about March of 22, we had a death cross in the S&P, and then by early 2023, we had a golden cross in the market, and the markets have been trending upwards since then. This week we got a death cross. So that's historically we've seen, just looking over these last 5 years, when you get this, you've often historically seen the markets grind sideways to lower for a number of months. We saw it in 2020, we saw it in 2022, 23 as well. So it's a pretty significant technical signal that we do keep an eye on as an indicator of shifting capital flows and market sentiment. Speaking of which, I'm just going to highlight a few charts now. This is the NASDAQ. We've seen the NASDAQ break down significantly, massive rally through 24, stalled out at the end of the year and over the winter. And then now in recent weeks, with last couple of months, we've seen it roll down significantly. And the NASDAQ remains under particular pressure, particularly with semiconductor stocks like NVIDIA getting hit today. The Russell 2000 is an interesting one. This got hammered in March and April with the overall markets, but we've actually seen it bounce back a little bit in the last 2 days, and that's interesting because normally we think of smaller cap stocks as being less multinational, more domestically focused, and perhaps less insulated or even beneficiaries from the change to trade policy, which is trying to bring a lot of manufacturing and other things back to the U.S. And interestingly enough, we are seeing that starting to play out in the Russell 2000. Quite intriguing. The TSX, we did roll down here in early April. It has stabilized and does appear to be bouncing back. US dollar CAD rallied up into a major resistance level over the winter, peaking around 145. It's now rolled back down. It's actually back under 140 as I speak. Now it's trading near about 139. So we have seen it basically pull back from a previous breakout point, has now become support after running into a long-term resistance level. So we'll be watching here with Canada. Does the dollar CAD break down and the loonie continue to improve from here, or does it kind of stabilize dollar CAD in this lower range for the loonie? I thought I'd look at bonds here, and we can see that bonds are still going sideways, and we see that with the Treasury yields, which are holding well above 4% at the moment, and that's kind of kept a lid on a rally that looked like it may have been starting in bond prices, but in the end, we're still just kind of in this big sideways range for bonds. Crude oil, as I've been mentioning, has broken down quite significantly. For the longest time, it was trading in kind of a 65 to 85 kind of range. I always called it the low end being the pain threshold for Saudi Arabia, where they historically cut production, and the high end being the pain threshold for the United States, where they'd start getting really upset and open up the strategic petroleum reserves. So, and that range held for the better part of 2-3 years, and now we've seen oil break down, and the breakdown in oil seems to be indicative that people are concerned that the trade war could slow the global economy, slow demand for resources. We've seen the pullback in crude, we've seen the pullback in copper. In terms of the equity action call, I've noted increased volatility, and this week we have seen with uncertainty that the equity action call has now gone down into the yellow zone. This measures as a macro measure of equity market risk, money flows, and overall price action changes between equity and non-equity asset classes. So as we've seen this market retreat, we have seen the relative strength of equity asset classes erode, particularly U.S. equities, and we have seen non-equity asset classes improve, particularly cash and currency have been moving up, while equities have been relatively underperforming of late, and so that has now pushed the equity action call down into the yellow zone, which is the neutral transition zone. So we're in a case now where things are kind of fighting themselves out, but most importantly, equities are no longer dominant. We're now into this transition, higher risk, higher volatility phase or intermediate. In the last month, we have seen a general retreat in world equities. The only market that's up significantly is India. Interestingly, Canada is pretty much flat, and then we've seen a couple of other countries also close to flat. The one that's been hit hardest lately has been China, which has been right in the crosshairs of President Trump related to the trade war and tariffs. But the U.S. itself is also down significantly, moderately this month, and it's indicative that in this kind of thing, the market is basically telling us that nobody wins in a trade war. If we look year to date, it's quite interesting. The U.S. is negative. We've seen a lot of strength, though, as I've said, in international markets. Top performers year to date: Poland, Spain, Germany, Italy. So a lot of European countries, and even China was positive year to date. China was doing extremely well until it sold off in the last month or so. I wanted to highlight our sector scopes. This is a look at the bullish percent or stocks on a bullish technical signal out of 31 industry groups that we track. They're similar to the GIX level twos, and so what we're seeing right now is it's fairly well spread across the spectrum. This is kind of suggestive that we had a big run up in the markets, we had a big sell off, and now things seem to be kind of stabilizing, potentially balancing out. The weaker sectors have been banks, conglomerates, and energy. The strongest sectors recently have been metals, um, computer software, and aerospace. And the metals are particularly interesting given what we've seen with the gains in the prices of gold and silver of late. I've talked before about the sector scopes and how we saw most recently we're kind of in this more normal distribution spread across the sectors. But I also like to say that when things pile up on the right hand side, it's a market that's overbought, or when it's piled up on the left hand side, it's a market that's oversold. And I just pulled this one out from April 7th as an example of what I mean when I say the sectors are piling up at one end, and we can see it here. Just about everything was down in the leftmost column. So it was getting a market that was getting extremely oversold about a week ago. Seasonality this year has been mixed. I mean, usually the first 4 months of the year are historically strong, and we had that in January. But then we didn't see the strength follow through February, March, April as we commonly would. We've seen markets decline February, March, April, and then and now we said, and we ask ourselves, well, now we're heading into what's historically been the 6 months of higher volatility and weaker market performance, and so now what? And so we ask ourselves the question of, has some of the traditional summer weakness been pulled forward, or could this be the beginning of a larger grind sideways to lower? It remains to be seen, but it's important for us to remember that so far, at least, the markets have done well in what has historically been the stronger time of the year. So, and now we're moving into what's historically been the choppier time of the year. I wanted to speak a little bit as well to the recent managed performance of our managed portfolios. And so I've talked about the equity action call going into the neutral zone, and and what does that mean? Well, we have been navigating through these volatile markets, continuing to use our rules-based and relative strength-driven investment strategies. And our portfolios have tactically shifted into a more defensive stance based on our analysis and our trading signals. So we have been increasing cash and reducing equity exposure. We've increased exposure to gold through gold equities. And even in the remaining equities that we continue to hold, we have cycled from cyclical sectors to defensive sectors. In recent weeks, the portfolios have been outperforming their benchmark indices. They've been the benchmark indices have been falling faster than our portfolios, and we have had seen the benefits of having increased cash and gold positions, or gold related positions. It's gold equities. Just to show our what this means in terms of our portfolios, we'll start with the ones where we're sub advisors to BMO Global Asset Management. And I've split our holdings into 5 sectors, a little different than usual, versus cash, which is cash and ultra short term fixed income ETFs. Then our traditional fixed income ETF portfolios, gold stocks and gold sector ETFs, defensive sectors, which are things like telecom, consumer staples, and healthcare, and then cyclicals, which are financials, industrials, tech, and consumer discretionary. And I'll note, even within the cyclicals, within groups that we would commonly call cyclicals, we've still taken, even within those, a bit more of a defensive posture. And I'll give you some examples, which are, we have rotated out of companies exposed to capital markets within financials, and the majority of our financial holdings right now are insurance companies. Within technology, over the last number of months, we rotated out of all our semiconductor holdings, and right now what tech holdings we do have are companies more like IBM, more traditional defensive, low beta for tech. I guess is probably the best way I can put it. So now, if we look at our portfolios here, we'll see that overall we're between about 16 and 40% cash, depending on the portfolio, most of which are kind of 16, 20, 34. So we have significant cash positions right now. We also have significant gold positions, between 9 and 18% in gold stocks or gold sector ETFs. Our defensive holdings are again a number of 10 to 30%, and the cyclicals are under half, and in some cases down to 20% holdings. So, for example, if we look at our global equity ETF fund, 40% cash, another 9% gold, 18% defensive sectors, and only 32% in cyclicals. In our North American equity ETF fund, 32% cash, almost 17% gold, 28% defensive sectors, and only 22% in cyclical sectors. And then in the Canadian equity fund, 16% cash, another 18% in gold sectors, another 18% in defensive sectors, and about half in cyclicals. Then, as we move forward and we look at our SIA ML Global Tactical Pool, looking at the same groups, we have 36% cash in the ML pool, 5% in gold related equities, 21% in defensive sectors, and about 37% in cyclical sectors. And if we look at our across our sleeves again, we have cash at about 36%, international is about 18%, Canada is about 12%, the US mega cap sleeve is about 22%, and the USA sleeve is about 11% currently. So, looking ahead, the tariff and trade war news continue to dominate headlines. We've seen significant uncertainty and ramped up intraday volatility. Earnings season has begun with a focus primarily on guidance. And what's interesting is we saw recently that Walmart and Delta Airlines basically threw up their hands and pulled their guidance and said, we don't know what's happening, and we can't reasonably predict, given the volatility that's going on in the business environment. So we'll see if we get more of that out of other countries. When the U.S. banks reported, they were all kind of warning that the trade war could have a significant impact on things. And our relative strength indicators have weakened recently. As I noted, we've now gone into the yellow zone on the equity action call. And of course, we continue to monitor the trends in capital flows, relative strength, our trading signals, and we remain prepared to make additional tactical changes as necessary. And this is our disclaimer slide. And so at this point, I would like to thank you all very much for joining us for our April webinar presentation. And we look forward to speaking to you again soon. Have a great day.